So markets have been very volatile the last couple of days. And when I say volatile, they've just been very jumpy. This was last night. We saw a really big jump on headlines that, China and the U.S. will be meeting in Switzerland to talk. And then, of course, we saw a big sell-off intraday when Trump said he wouldn't remove the tariffs that are currently in place. And then we had, the normal chop around the Fed meeting. And then we got a last-minute rally on some news that the Trump administration would roll back or undo some of these restrictions around AI chips that were due to hit the market, were due to hit on May 15th. So market's really sensitive right now, and responding very quickly on very light volumes on, every headline that's taken place. And so this is just a 5-minute bar. And you can see yesterday we moved 92 basis points on 11,000 contracts. And earlier today, we moved, 52 basis points on 30,000 contracts. So this is just, the constant moving back and forth. I mean, today we had a little bit more normal volumes, but what it's telling us is that liquidity is very thin, top of book very thin. We've talked about all this before. And so I think you really have to be very careful with these markets, especially given that you see these big moves and then they're basically given back over the course of a day or a course of 2 days. This was Thursday evenings and Friday mornings rally, and that was all given back by end of day yesterday. So, again, this is just a very tumultuous period of time. And really the big thing that stands out is what you're seeing taking place in some of these currencies in Southeast Asia. This is the Taiwan dollar. Now, we don't really talk about the Taiwan dollar very often, but this is a historic move. I mean, you had a 4% drop followed by a 5% drop, and you're rebounding a little bit, about 3% or 4% or so the last 2 days. But this is an historic move. I mean, you don't see moves like this in the Taiwan dollar very often. You might only see this as like a once in a every 10-year type of thing. You can go back and you can look at the weekly chart and see it a little bit more clearly how big of a move this is in such a short period of time. And it's really not just in Taiwan that you've been seeing it. You've been seeing it in South Korea. That obviously had a big move. You've seen it in the Thai baht. You've been seeing it, these big moves in the Malaysian ringgit. And so this is really something that's happening all over Southeast Asia. This is Indonesia, not quite as severe, but what it's pointing to is that there's a sensitivity, there's something going on in that part of the world that people are getting really worried about. And so that's causing, now these aren't currencies depreciating, these are currencies that are strengthening because they're quoted US dollar, Taiwan dollar, very much like you would quote the Japanese yen. And so basically, when you look at the CNH, the Chinese renminbi, you can see there's really been some pretty big moves also in this. Remember, this is basically a controlled currency, right? Where the PBOC sets the midpoint of the range every night. So it's not really very common that you see these types of moves. And really, when you kind of think about what Taiwan represents, you think about chips. When you think about South Korea, you think about chips, memory chips specifically. You have Samsung and Hynix over there. And, and then, of course, today you get that news and that piece of information about AI chip restrictions coming off. And you wonder why you're seeing these big movements, not just in these currencies, but these currencies this is a sign of repatriation, money leaving the US dollars and going back into Taiwan dollars, going back into South Korea. And so when I kind of think about these things and I think about the news, I think about everything going on in the administration. And so this is the Section 232 that was put up on the Federal Register back in early April. And basically the public comment period ended today. So what this means is that really after today, all these comments have been submitted, and you could see the administration enact tariffs on semiconductor and chip equipment over the next, whenever it wants, over the next couple of months. If it wanted it to, could do it, I guess, tomorrow, if it wanted to as well. So this is something to really keep in mind, that there's this potential for tariffs coming on the chip sector. The Pharma Section 232 also closed today with this public comment period. They've been talking a lot about pharma tariffs coming. And so chip tariffs certainly could be coming. One of the pieces of news that was in that chip report was that they were going to work on making something better, more stringent. And so these movements in these currencies sort of align with some of these pieces that are going on in the chip space. And so it's something that I think is worth continuing to pay attention to. The other thing I think that's obviously very important right now is what's been happening with the Japanese yen, with the dollar in general, especially against these bigger currencies. And you can see for the most part, you really haven't had a major change in these currencies. They're kind of just continuing to do the same thing. And one thing that I like to watch quite a bit is these swap spreads, these cross-currency basis swap spreads. This is the Japanese yen, US dollar. Again, this is a good one that I like to watch just because you can see it kind of mimics and it goes with changes in the S&P 500, which is in blue. And what this is suggesting and what this was talking about, I was mentioning this over the weekend, was that we were looking for a potential pullback in the market. And this was one of the reasons that I cited that you were starting to see signs in some of these cross-currency basis swaps that were tightening a little bit, meaning dollar funding is getting a little more expensive. And you've seen this specifically also in the euro the last couple of days, the white line also moving down pretty sharply. And what this is suggesting to me is that the recent move up in the market we've seen in the S&P 500 is probably, at least for now, run its course. And even when you look at some of these other indices and metrics we use, and we've talked about over the weekend as well, which is these BTIC S&P 500 total return futures, which basically measure the cost of financing, the cost of leverage. And what you can see here is that this continued to decline the last couple of days. This is for December. This has moved down to 43.5. Again, if you overlay the S&P 500 futures on it, this is also showing you and telling you that the S&P 500 has been divergent from this. And we talked a little bit over the weekend about how in 2022, especially when you look at the second month generic contracts, as this was falling and you got these rallies in the S&P, you didn't really get it confirmed and verified by these S&P 500 total return futures. And so you're seeing a very similar thing happening now. Again, there's no verification of this move up that we've seen really since, call it, the April 23rd time zone. So right now, again, you're sort of looking at an equity market that is very choppy, very anxious. There's obviously a lot of risk in this market right now. I think the chip tariffs and the potential for those to be announced, which really I'm not saying they're going to be announced, but the expectation I have is that there will be something, because Trump has said that he wants sectorial tariffs, and one of those things that they want are on chips and pharma. And it's one of those strategic industries they want to bring back and onshore. So I think you have to be very mindful of that. What they were excluded from were those reciprocal tariffs, not from the potential sectorial tariffs. And again, technically speaking, the S&P 500 continues to be in a spot that looks like a good area. If you're going to see a pullback in the market, this looks to be a pretty good place for that to happen. Here's your July of 2024 high. Here's your 200-day moving average in blue. Here's your 61.8% retracement level. If you want to get creative with your technical analysis, you can call this an inverse cup and handle. It looks like that may have broken. I guess I could probably try to draw it a little bit differently, but it still looks like it's basically broken. And again, this also looks like a sector, and this looks like a section of the market that could be serving as some sort of top over the near term. And when we look at 10-year rates, they didn't really move very much today despite the Fed's inaction. Again, expectations are really kind of growing that the Fed's been worrying about, the risks of higher inflation, the risks of a higher unemployment rate. And what they're really telling you they're worried about is they're worried about stagflation. And, when you look at the dollar index, and that's been really collapsing, moving lower, there's probably indications in here if this is a bear pennant, maybe the dollar continues to move lower. You really haven't seen rates go down despite all this news. In fact, 10-year rate today is exactly the same spot it was in October of 22. So all of this stuff has gone on, and you really haven't seen rates come down at all. They've really more just been range bound. And I think the risk here is that the rates can actually start moving back up again. Next week, you're going to have CPI, you're going to have retail sales, PPI, and a whole bunch of other things. which could also push rates up. But, when rates don't go down, when long end rates don't go down, long end rates don't really change, and you have a dollar that's declining, that's basically your green light that the market is pricing in stagflation. And, typically, if you go back and look in the 1970s, those weren't exactly good periods for markets, for equity markets. There was a lot of rolling bull and bear markets. I can show you really quickly. So here's the 1970s kind of summed up with just lots of really big, corrections in the market, lots of really big rallies. And just to give you a sense of how big these are, this was a 37% decline. This was followed by a 75% rally. That was followed by a, roughly 50% decline. And this was followed by a very good rally again, another 70% rally. And then, of course, you got another big decline here, 20%. And then eventually you made that low in 1982, which with that recession, and that kind of wiped it out. And then you were off and on your way. But what this kind of shows us is that there's lots of times if you go into this stagflation type of environment, there's going to be a lot of choppiness. And I think that's kind of also starting to get worked into the market as well, although it's a little bit slower on the equity side of the equation. Anyway, I hope you have a great rest of your week. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon. Bye.